On October 14, 2025, JPMorgan CEO Jamie Dimon was asked about minor cracks appearing in the credit markets. His response became the defining quote of the year. "I probably shouldn't say this, but when you see one cockroach, there are probably more." Dimon wasn't making a joke. In the months since, that single bug has evolved into a wider infestation of criminal trials, frozen investment funds, and a default rate that sets a new record nearly every month. The host for this rot is the private credit market, a $3 trillion ecosystem operating with a fraction of the transparency required of traditional, regulated banks. This non-bank channel has reached a critical tipping point, now accounting for over half of all U.S. corporate financing. The American economy now relies on a massive shadow system that functions almost entirely outside the reach of standard regulatory oversight. The triggers for Dimon's warning were two sudden collapses: Tricolor, a subprime auto lender, and First Brands, a major auto parts supplier with over $10 billion in debt. Wall Street's initial reaction was dismissive. JPMorgan's own CFO characterized these as isolated instances of mismanagement rather than symptoms of a systemic breakdown. That narrative shifted when federal prosecutors charged the founders of both companies with running systematic fraud schemes that had been operating undetected since 2018. Prosecutors alleged the founders spent years inflating the value of their collateral to raise billions from unsuspecting lenders before the companies finally buckled. Private credit's structural opacity shelters criminal behavior, allowing multi-year frauds to flourish without the scrutiny of a regulated banking audit. The Fitch private credit default rate has climbed every month since Dimon's comment, reaching 6.0% by April 2026. Of 99 recent default events, 81 involved borrowers failing for the first time. The rot is reaching healthy borrowers. The true severity of these defaults is partially masked by an accounting mechanism known as payment in kind, or PIK. PIK allows a struggling borrower to stop paying cash interest and instead add that unpaid amount to their total loan balance. On the balance sheet, the loan stays current, even as the actual debt grows. This creates an illusion of stability, allowing a massive debt crisis to compound in the background while the headlines remain calm. The realization of these risks triggered immediate contagion. Investors pulled $500 billion from alternative assets, and publicly traded business development companies began trading at deep discounts. In February 2026, Blue Owl Capital permanently halted redemptions on a $1.6 billion fund, effectively locking the doors on retail investors who needed their cash. Then a new, unmodeled threat emerged: artificial intelligence. Investors began to fear that AI coding tools would let companies build their own software, eroding the margins of the enterprise software firms that private credit relies on. Shares of major managers like KKR and Apollo sank on this fear alone, long before a single loan in the software sector had actually shown signs of trouble. This market is vulnerable not only to bad loans, but to sudden technological shifts that current risk models failed to anticipate. There is a heavy irony in these warnings. The institutions sounding the alarm are the same ones providing the capital that keeps the private credit market alive. In early 2026, JPMorgan disclosed roughly $50 billion in exposure, specifically tied to private credit structures. Citigroup reported its own private credit book was fully securitized, with zero historical losses, though that is the bank's own internal characterization. The systemic risk remains difficult to quantify because the loudest watchdogs are also the market's primary funders. This has split Wall Street into two camps. The crisis camp, including Jeffrey Gundlach, views this as the most likely candidate to spark the next major financial collapse. The normalcy camp, led by Goldman Sachs, argues that PIK income and non-accrual rates remain well within historical norms, suggesting the alarm is premature. Because of the market's $3 trillion scale and interlocking bank exposure, even the world's most sophisticated analysts cannot agree on whether the system is currently failing. To spot the next cockroach, focus on three specific metrics: the monthly Fitch default rate, the percentage of income derived from PIK, and the quarterly exposure disclosures from the big banks. That is where the rot will appear first.